Okay, well, good afternoon, everybody. For those of you who don't know me, I'm Tom Clockerty. I'm the Executive Director of the Adam Smith Institute, and it's my great pleasure to welcome you all here today for our lunchtime seminar with John Redwood MP. As you've no doubt noticed from the little booklets on your chairs, today is also the launch of our latest publication, Credit Crunch, The Anatomy of a Crisis, which John has been kind enough to write for us. And now, the thing with John, of course, it's a cliche, but John really doesn't need very much introduction. But by convention, I'm obliged to say a few words anyway. John has been the Member of Parliament for Wokingham since 1987. He's chairman of the Conservative Party's Economic Competitiveness Policy Group. In government, he served as a Minister for Trade and Industry, for local government in inner cities, and in Cabinet as Secretary of State for Wales. While in opposition, John has been the Shadow Secretary of State for Trade and Industry, for Environment, Transport and the Regions, and for deregulation. John is also quite a prolific author, the author of numerous books, and he maintains one of the best blogs in Westminster, which is available at johnredwoodsdiary.com. One last thing, if you could all switch your phones to silent before we begin, that would be very much appreciated. John, over to you.
Chairman, ladies and gentlemen, thank you all very much for coming today to the launch of the Adam Smith publication, Credit Crunch, Anatomy of a Crisis. I'd like to say a big thank you to the Adam Smith Institute for inviting me to write this piece and for publishing it so well and so promptly. It is timely, and the arguments in this pamphlet and the arguments around the credit crunch generally are going to be with us and haunt us up to and through the general election period, because this is a very big and very deep crisis, and one which will determine our politics for several years to come. I'll just put this down. I think we've had three big phases to the credit crunch crisis so far. In the first phase, 2003 to 2007, we had irresponsible monetary policy. We had very lax and irresponsible banking regulation, and we had irresponsible bankers who took full advantage of the generously loose monetary conditions which were being set. The Monetary Policy Committee of the Bank of England couldn't see the excess, and so they kept interest rates far too low for far too long. The banking regulator couldn't see the excess, even though it was staring you in the face on the published balance sheets of the banks, let alone on the confidential returns they made to the regulator, and they allowed it to continue. Indeed, they, with the government, went off and negotiated a new Basel agreement, which would have relaxed the capital requirements on the banks at around the height of the boom and the height of the excess. And we had, during that period, banks that thought that risk had been reduced because everybody was doing it, because you could parcel your debts up and sell them on to another bank, because there were ways of securitizing your risks. They felt that the markets would always be liquid, and so they could accept more risk than they had done heretofore. It also shows the danger of very prescriptive regulation, because if you have prescriptive regulation saying that you can gear yourself up to this level, that you can borrow that much up to this level with that amount of capital, it is quite tempting for bank directors to think that is a safe level, and they will be under pressure from the market to borrow themselves up to that level, because otherwise they have shareholders saying, but you're not maximizing our returns, because even the regulator thinks that you can gear more, borrow more than you're doing. So we had that long, irresponsible phase where we had major regulatory catastrophe allied to bankers who, for good and bad reasons, decided to exploit the conditions and overlend and overborrow. At the same time, they developed all kinds of new instruments to increase the risk. So you didn't just have to look at the risk on the bank's balance sheets, so that was excessive and big enough, but there was also risk off the balance sheets because they found ways of extending the risk through the system. It is a bit naive of governments, particularly the British government, to now turn around and say that was nothing to do with them or they didn't want it. Because they, after all, were the architects of a lot of the off-balance sheet lending and borrowing, because they wanted to borrow so much more for themselves outside their own balance sheet. So they worked with the banking sector on PFIs and PPPs, ever bigger amounts of money being borrowed, not going through the regular public books and the public balance sheet. And that created a spirit in which I think large private corporates also said to themselves, well, if this kind of off-balance sheet venturing through different special vehicles is all right for the government, maybe we ought to be doing a bit of it as well. Sometimes the government forced them to do it because they needed to form a special vehicle in order to undertake the government work that was on offer. The politicians also intervened early in this period by changing the inflation target in the United Kingdom, something I opposed very strongly at the time. I felt that the obvious consequence of changing the inflation target from the RPI to the CPI was going to be lower interest rates for longer, because that was the time when, over quite a long period, the CPI went up much less quickly than the RPI because of the housing component. And so by setting a CPI target, which didn't adjust fully for that big difference, the government was saying to the Bank of England, please don't raise interest rates through a general election, please keep interest rates lower. We're enjoying the party that this easy credit is creating.